All right, let's jump right in. Welcome to today's Explainer, where we are setting the stage for a really fascinating deep dive into global economics, currency volatility, and exactly how nations build absolute financial armor to defend their wealth. If you've ever wondered how global headlines end up impacting the actual money in your pocket and how central banks are operating behind the scenes to protect it, well, you are in the exact right place. We've got to start with a number that is flashing red right now, 96. The Indian Rupee has just breached the crucial 96 per dollar mark. Just to put that into perspective for a second, this is its weakest closing level since June 8th. The currency had actually been appreciating in recent weeks, mostly thanks to a coordinated set of measures from the Reserve Bank of India. But suddenly, it's right back in the red, having given up almost all of those recent gains. So what's actually driving this sudden drop? The immediate triggers are largely external. Escalating U.S.-Iran geopolitical tensions are sending investors rushing towards safe haven assets, namely the U.S. dollar. That same tension is driving crude oil prices up to a one-month high. You combine that with shifting foreign portfolio flows, and you got a perfect recipe for pressure. The rupee has weakened by more than 0.8% so far this fiscal year, and we even saw a sharp 48 pace drop in a single trading session. It got so intense that the RBI had to actively intervene and sell dollars via state-run banks just to limit the decline. Here is our roadmap for today. Rupee under pressure, the currency collapse, the export-led recovery, and finally, building financial armor. Section 1, Rupee under pressure, immediate impacts. Let's look at that 3.17% forward premium. In plain English, that tells us the market firmly expects this weaker 96 level range to stick around in the near term. But listen, it isn't just geopolitical shocks causing this. There is a massive, ongoing, structural demand for dollars at play. India's trade deficit, corporate dollar demand, and heavy external payment obligations all create this continuous hunger for U.S. dollars. And that structural demand essentially eats up the temporary forex boosts the RBI previously injected into the market. Section 2. The currency collapse, when depreciation becomes a crisis. So, what exactly happens when a currency just collapses? We're talking a massive depreciation of 20 to 50% in mere weeks. Well, the recovery from that is a long, painful, multi-year adjustment process. Restoring macroeconomic stability absolutely does not happen overnight. It typically takes a grueling 2 to 3 years of structural adjustment before real, sustainable economic growth comes back online. I like to think of this devaluation as a two-sided coin. On one side, the immediate impact is brutal. Everyday consumers suddenly can't afford foreign goods. The country's dollar-denominated purchasing power is crushed, imports double in cost, consumption plummets, and boom, you get a recession. But look at the other side. Eventually, you get this delayed benefit of export expansion. Because the local currency is now so incredibly weak, the country's goods become incredibly cheap on the global market, which acts like a steroid injection for job growth in export sectors. But before we get to the eventual good news, we have to acknowledge the immediate shockwaves, because they are devastating. Import prices double literally overnight, which renders corporate foreign debt totally unpayable. Everyday savers lose massive amounts of purchasing power, and unemployment spikes. A perfect historical example of this negative demand shock is Indonesia in 1998. They imported heavily for industrial production and food. So when their currency collapsed, import prices doubled, producers couldn't afford raw materials, citizens couldn't afford food, and it triggered a severe, devastating economic contraction. Section 3. The export-led recovery, the path back to growth. The good news is that economies do heal. Take Thailand back in 1997 as a prime example. The Thai baht dropped by about 50%. Suddenly, a Thai factory manufacturing computer hard drives at a cost of 1,000 baht could offer them to global buyers at a 30 to 40% lower US dollar price, all while completely keeping their profit margins intact. Foreign buyers realized they could get the exact same goods vastly cheaper than from Japanese or Korean competitors, and massive export orders just flooded in. But here's a crucial question I really want you to think about. If exports instantly become cheaper, why does this export-led recovery typically take 18 to 24 long months to actually show up in the economy? Let's take a beat and consider why that lag exists. Well, the answer boils down to real-world logistics. You can't just flip a switch and instantly double a factory's output, right? Exporters first have to rebuild their depleted local inventories. Then they cautiously test the waters to see if this new foreign demand is actually sustained, rather than just a flash in the pan. Only after that do they take the very costly risk of undertaking physical capacity expansion. And that reorganization, it takes quarters to execute. And this creates what economists call the J-curve recovery timeline. Basically, it gets worse before it gets better. In the first couple of quarters, imports are painfully expensive and consumption crashes. By year one, you see real GDP contraction. South Korea, for example, shrank by a brutal 6.7% in 1998 during the IMF crisis. But as export volumes finally scale up, by years 2 and 3, GDP growth roars back. South Korea bounced back to a massive 9.5% growth in 1999. The country takes the initial hit, but then comes back even stronger. Section 4, Building Financial Armor, Central Bank Defense. Okay, wrap your head around this staggering number, $102.3 billion. That is the current value of India's physical gold holdings right now. For the first time ever, the Reserve Bank of India holds gold worth over $100 billion. We are talking about approximately 822 tons of physical gold. To put that into perspective, that's roughly the weight of 140 adult elephants. And it is all securely stored locally in Indian vaults and abroad. And there's been a massive shift here. Gold now makes up about 15% of India's total forex reserves. Just a decade ago, it was hovering around 7%. It has more than doubled. And this is not an accident. It's a highly deliberate strategy that aligns with a broader global trend among central banks of de-dollarization, basically reducing their over-reliance on the US dollar amid all this global economic uncertainty. So, how does this all fit into the bigger picture? Well, India's foreign exchange reserves rely on 4 key pillars. You have foreign currency assets, which are your standard dollars, euros, and yen. You have special drawing rights, which are created by the IMF. You have the reserve tranche position, which is essentially India's accessible IMF quota. And then you have those gold reserves. By diversifying heavily into gold, the RBI protects itself from the risk of standard paper currencies suddenly losing their value due to inflation. Now, to be completely fair and balanced, we do have to talk about the downsides of this strategy, because stockpiling gold isn't perfect. Gold is heavy, it's cumbersome, and unlike hitting a button to wire dollars, it takes a whole lot of armored trucks to convert it to cash in an emergency. Plus, it's a zero-yield asset. It pays no interest, unlike a government bond. And finally, the logistics. Holding 822 tons of gold incurs incredibly high storage and insurance costs, especially for the portion they hold overseas with institutions like the Bank of England. But even with those costs, the core takeaway of our explainer today is really captured perfectly right here. Maintaining a balanced mix of gold and foreign assets is absolutely key. In a world of volatile oil prices and unpredictable geopolitical crises, financial sovereignty simply isn't built on just one currency. It's built on a diversified, shock-absorbent portfolio. Gold provides that intrinsic stability. It acts as the ultimate inflation hedge. And for everyday citizens, this strategy is what ultimately protects national purchasing power when global markets start to panic. So, I'm going to leave you with one final provocative thought. As we watch currencies like the rupee battle these massive external pressures, how will increasing global geopolitical fragmentation shift central bank defense strategies in the coming decade? Are we witnessing the golden era of the US dollar slowly making way for a brand new era of hard asset stockpiling? It is a truly fascinating shift to watch. Thank you so much for joining me on this explainer, and keep your eyes on the data.